And just to reiterate on the disclosure front, remember that options carry some risk. We talked about the risk that's involved there, and stops don't guarantee that we will get out at a particular price, one to the other. Now, why do I say I'm doing a super quick the market overview? It's because Kevin Horner, 4 days a week at the Market Open, does a Trader Talks class where they're doing a very in-depth view of what's going on in the market overall. And so, he was there this morning. So you guys want to catch that if you can. But basically, when we look at this trend on the S&P 500, if we go out to the 1 year on this, and if I come down and say show price as a percentage, we can see that in the last 12 months, this index is up 29%. So that is not too shabby. On Friday, sorry, just get rid of this. I can get rid of these scripts now too. We'll get rid of these. On Friday, this market hit a new all-time high. So, as one of our former coaches used to say, hitting new highs is not bearish, right? Right. Okay, so when we look at the NASDAQ, kind of more of the same, right? Like in the last 12 months, up 40% in the last year, hit a new all-time high on this index on Friday. How about our small caps? So this is 2,000 of the smallest of the Russell 3000. And, I would call this a bull flag in a stiff wind, but this index up over 40% in the last 12 months. And we've got this flag pattern happening here. And, within a stone's throw of this intraday all-time high that was posted on April 21st. So close to all-time highs here. And to round out our fourth, so the Dow hasn't quite made it back up to the all-time highs, but up a respectable, 22% in the last year, in fourth place out of the four indexes, but still 22% is not too bad. And again, kind of this bull flag type pattern happening here. And then when we come and we look at the VIX, and why do we care about the volatility index? It just kind of gives us a sense of how much fear there is in the market. Also, this impacts option prices. So when we have something that's sitting under 20 and we're back under 18, we're back at 1862, it means prices are going to be certainly more reasonable on options than they were when they were sitting up around 30. So this can make a buying strategy perhaps more interesting, shall we say. Okay, so let's come and look at our first setup today. So we have over 7,000 in our account. Our max position size in this account is 5,000. And you may say, well, like, are you crazy? Like, that's awfully high, don't you think? Well, if you had $1 million portfolio, you might say, well, I don't want any one position to represent more than 5% of my portfolio. So that'd be, it could be a 50,000 position. If you took a million, have I got the right number of zeros there? I need one more, times decimal 0.5. So that's a 50,000 position, and which is bigger than this entire account is. But for us, we wanted to be able to do buy right covered calls or other trades using stocks. And it doesn't mean we have to do a $5,000 position, but if we're looking at this and we're saying, well, if we did a $5,000 position on a, let's call it $31,000 account, this is 16%. But, if we get this account to 40,000, we might still leave this 5,000 dollar position in place until it grows to the point where maybe that $5,000 represents a 10%. But that's why we started with that. And our max loss per position we have set at 5,000, or sorry, 500. And you know, this account has grown a bit since we started at 25,000 at the beginning of the year. And you know, you know, we've been kind of treading water with this one for the last couple of months. It stayed kind of in this range, but this is a paper money account. So sometimes you get paper money fills and you know, that you might not get in a live account and that kind of thing. Also, transaction fees don't come out of this account of paper money. So there are some additional nuances and differences. But when we look at Bank of America, and if we look at the financial sector, so if we came here to our sector indices and we look at financials, you know, it was kind of pulling back along with the rest of the market. And then we had this diagonal resistance breakout. And today we have this bullish engulfing pattern, you know, at what may be the indication of, you know, the end of a bull flag. So if this were the close today, we'd have that close above the high of the low day. This is also a bullish engulfing pattern. And so if we come back to Bank of America and we say, okay, well, it looks like this sector is strong. The market is strong. Could we come out and look at this and say, okay, this is 52.62. If we bought 100 shares or 90 some shares, the reason we might want to do 100 shares is that, you know, we could sell a covered call, but we're kind of at a support level here. I don't know if we could sell the 54 and get a whole lot for it. Well, we'd get 62 to 64 cents. You know, if we came out 18 days, if we came out 25 days, and we might want to be in that more of that 20 to 50 day time frame. Even on the weeklies, we've got a lot of volume here. So if we wanted to do just a simple swing trade, we could just put in that target of 54.50. Or we could say, well, how about we make the target 54 and we sell this covered call? And so would that make it worth our while? So if we come here in Thinkorswim parlance, they call this buying covered stock. So it would cost us 51.82. The most we could make is 54. And so if we look at that and we say, okay, 54, if I subtract that 51.82, so $2.18, if I could make 218 on this, and if I were called out, how long would we be in this trade? Well, 25 days, so, you know, not even a month. If I divide that by 51.82, is that going to be worth it? Well, it's got to be close to 4%. It's 4.2%. And so if we said, well, gee, if I could make 4.2% and then, you know, wash, rinse, repeat, you know, would I be okay with that? And if your answer is yes, then you place the trade. Now here we might say, well, where might we put a stop? And if we look at today's low at 51.83, here our low was 51.93. So if I took this 51.83 and said, hey, if it breaks below that, because I see that being a new support level by 3%. So if it goes down to 50.27, like let's call it a day. Let's exit. Okay. So now we're trying to define our risk to the downside, and we're looking at here doing a buy right covered call. And it's May 25th. Was it the 25th? Just a sec. I've got Labor Day on my mind, or Labor Day, Memorial Day. Let me just double check. May 22nd. Okay, so we've got May 22nd. And so we're going to come to our single order, first trigger sequence. We're going to right click, create an opposite order, and we're going to make this a market order because we both have to buy back the call we're selling and then sell the stop. And so we're going to click on our conditional order box and say, hey, if this stock goes below $50.27, let's get us out. And so, there's no guarantee that we'll get out at exactly this price, but that's the goal. And then we hit save. And so if we were out at 50.27, we'd be risking about $150-ish. So, and the most we can make is 223. Now, this is saying the most we could lose is 51.77. Well, that would occur if Bank of America, went to zero in the next 25 days, which, the likelihood of that is not high. Okay. And so this is a bullish trade, and we're just looking to make our 100 or 200 a week. And if we were called out and we made that, $223, like that would help us meet our goal, right? Right. Okay. So let's look at a second opportunity. And let's come and look at, let's look at CrowdStrike. Okay, so CrowdStrike was kind of on the struggle bus. I mean, year to date, it is down 2.5%. In the last 12 months, it's up a meager what, like 9%, 8%-ish. And so, but what I think is interesting on this chart, if I'm playing I Spy with my little eye, do you see what I see? Because some might call this kind of a sloppy inverted head and shoulders. Some might look at this as kind of a double bottom. But I mean, one way or the other, it's gone through this period of consolidation since, February, right? And I see kind of like a cup and handle pattern, and it's broken out, and then it came back and it did a retest. Friday, we had this doji or this hammer pattern. It was an inside day, which is considered to be bullish, a harami pattern. And today, this is a live candle, so it could change. But, we've got this close above the high of the low day. So that would be considered an entry. And so if we were looking at this, we could do a short put vertical. But if we're bullish on this, and, we do have earnings coming up, down the road here. But if we are bullish on this, could we do a long call vertical? This is a $450 stock. So the options are likely to be pretty expensive. So if we come out here and we look at the monthly, we've got about a $1.50 bid-ask spread, which we wish it was tighter, but we've got adequate volume and stuff here. If we come out to May 22nd, 24, 25, 26, 27, it's over $3. It's more than 10%. But 18 days doesn't give us a lot of wiggle room. So if we come out to June, this is, less than, we've got $1 widespread here. This is 75 cents. So could we do the 450 and the 460? It only has to go up by 235, and we've got 50 days for it to get there. And so could we come in here and buy a vertical? And so how much could we make on this? We could make over 100%, because the most we can lose is 485. The most we can make is 515. The goal is for it to go above both of these strikes and stay there. It's already above the 450. But our plan with these, I guess I hit save by mistake. So we'll just reload it. Our goal is to get a 50% return. So Juan is saying, what do you consider good volume? So we just did an example trading plan about a week ago in the long vertical class, and I'm recreating one for the trade management mini sessions this afternoon. So you should see that by the end of the week. But our example trading plan, we want more than 1 million shares traded on the stock each day. We want at least 20 times the number of contracts we're going to trade. And so, you know, we've got almost 2,000 contracts on the 450 strike, 1,500, you know, in open interest. So we've got tons. And then we want less than a 10% bid-ask spread. So, you know, we've got, is it meeting those rules? Check, check, check. Do we have an entry on the chart? Check. So check, 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 check. Okay. So, but good question. I like that. And so we're going to put in a target here at 50%. If I round up, because if it was, this was 5, oops. I'm going to get rid of that. Must be the beginning of the week. I'm having trouble talking and doing things on this platform. Okay, I want that one to be gone. Why is it closing up the whole thing? Let me come to the monitor, trade. Vertical. This is just weird. Okay, delete the whole thing. Now maybe I can come back. Must be Monday. Okay, first trigger sequence, right click, opposite order, and we're going to make this 750. So 50% higher. When this gets to 750, we'd like to close this out. Now, we're going to put this in our long call vertical bucket. Okay. So there's that one. Now we have a lot of long call verticals already in our account. And someone, and I want to say hello to all of you guys who helped bring this class to life. So to Will and Charles and Debbie and Juan and Jay and Sharon and Bill, and yeah, like some of your handles are really great, by the way. But to Riceberg and Frank and the rest of the gang, thank you. But someone asked the question, can we look at LRCX? And so I can see why this one may have come up. But the idea here with the long call verticals, if we're up 50%, we want out. If we're down 50%, we want out. And say NVIDIA here, we're up 33%. If this was down, even if it was just down by $10, I then might want to go look at the chart on this to see if we had like a hanging man or something setting up. But this is just kind of moseying along, doing its thing, another kind of period of consolidation, kind of, you might say double bottom, cup and handle-ish, or just breaking out of a range. And so, oh, this is CrowdStrike. NVIDIA was doing the same thing. Okay, so, you know, it's just continuing on up the hill. So we don't have anything to do on this. With Lamb, it is down 35%. We will manually exit this if it ends up down 50. But right now, it's just continuing to kind of consolidate after this big run to the upside. And so we're going to kind of let it be, let it percolate. Okay. But if you were in a hurry, you could just look at this quickly and go, nothing I really have to do here. With Citigroup, we're down on this 36%, but today it looks like it's coming around the bend. Now, there is a section that we do have to manage daily. And so this one, we entered this thinking, you know, it was a one-day pullback. It was going to continue up, and it did. And then it's pulled back. So kind of a bull flag setting up, and looks like it may be moving to the upside today. Now, the other section that we manage daily is our long call verticals. So when we look at these, I can tell you that the one on Alcoa is a swing trade, and the one on AEP, also a swing trade. And so we don't have to manage our exits daily on these. But we put swing targets on this. AEP, let me just change my time frame, you know, seems to be coming up, you know, in an average day, this moves $2.35. You know, so if it moved up another 235 tomorrow, we would be at our target. Now, the other two, Affirm and Microsoft, require daily management because these have a 1 ATR target. And our deal with something that has a 1 ATR target is that we are going to move the stop up if it doesn't hit our stop. And yes, last week I taught like 5 extra classes. And so that's my excuse for missing. On this, we put the trade on the 21st, last Monday. On the 22nd, we should have moved the stop up to, and this is like a $400 stop. So, you know, we should have moved this up. When it's over 200, I moved the stop up to $2 below the low of the day. But when I looked at it again, it was here. So I moved the stop up to $2 below that. Now, if you had moved this stop up, you would have been out of this one on Wednesday. And now Friday, it moved up. And so if we look at this low was 415.80. So if we say, okay, we're going to move our stop up to 413.80, we would come here to our working orders. We'd scroll down to Microsoft. And then we're going to come and cancel and replace our order. We're going to bring up our box and say we're going to move this up to 413.80. So 413.80. And so, you know, it was 407. And what we're trying to do is just manage the damage if the trade doesn't go according to plan, or protect some of our profit. Now, you know, if the stock gap's up or down, we might not get out at exactly the target we requested. So we've left the target the same, and our stop we've moved up to 413.80. And this is for our 1 ATR target and exit. Okay. The other one, you know, when we just placed this one on Friday, so we did a trade on Affirm, but just to show you another example in action. So with Affirm, we placed this trade Friday. It's moving up. Like, let's just assume that, you know, this is the end of the day. 63.21. At 63.21 is the low of the day. So if it went 50 cents below that, 63.21. So I'm writing that down. 63.21 minus 50 cents. 63.21 minus 50. If it goes to 62.71 would be our new exit. Because our 1 ATR was, you know, 1 ATR below this. You know, whatever that ATR was, 324. So if we come back to our monitor tab, we'd come to Affirm, and we're going to cancel and replace, bring up our disappearing, reappearing conditional order page, and we're taking that 59 and we're moving it up to 62.71. And the idea here is that we want it to move quickly up to our target. You know, we're trying to catch something in momentum and go for a little win with these 1 ATRs. And if it doesn't go according to plan, we want to manage the damage by getting out quickly. So same target. If it goes below 62.71, we want out, and that's our 1 ATR target and exit. Okay. Okay. So that's our second one. Actually, that's what I really wanted to look at reviewing today, was the long call verticals and our long call trades with those 1 ATR targets. Okay, and let me just look at the chat. Yeah, since the market is uptrending, somebody's saying, since the market is uptrending, is this why you're placing more bullish trades? Absolutely. Because we're trying to go with the flow of the market. And then we're looking at stocks largely in sectors that are also uptrending. So if you have the market uptrending and then the sector uptrending and then the stock looks like it's making a move to the upside. And even though earnings is coming with these 1 ATR trades, the expectation is that we would be out. We would be out prior to earnings. Okay. So why am I changing the stop on Affirm again? So because that's part of the trading plan. Okay. So and this is one of those things where, you're going to want to subscribe to the Trader Talks channel. So if I just bring up a page and we come to Trader Talks, the first thing that comes up is what's currently being taught. But if you come to playlists and then scroll down, and we want to find the trade management mini sessions. And this is just a folder I created so that I could create a bunch of additional content for you guys. And I'm in the midst of this series. We've got 13 very short videos on candle patterns. But then the next big section is this section in blue, which is example trading plans. So here's an example trading plan for a short put vertical, which we're about to do. There's an example trading plan, the one for long call verticals. So the long put verticals is still here. I'm going to have to re-record it, but it had thousands of views and they've just taken it down because it's been up for a couple of years, 2.5 years, I think. So I will re-record it and you will find it here. But then I also did a long call with 1 ATR targets. And when you look at that, the idea of this example trading plan that you can then use to make your own trading plan is that with that 1 ATR exit at the end of every trading day, if it hasn't hit the target, we move up the exit because we're trying to protect a gain if we have one or minimize our loss. Okay, so that was a good question. Okay, so I think I've got most of them, and Kevin has been hopping in when he can. So, and I'm glad you're finding those example trading plans super helpful. That's why I have recorded them. And then if you keep scrolling down, these are just additions. Sometimes we'll have a whole bunch of trades hit targets in a short period of time. So this is really an add-on to the trading a smaller account class to review, to do a post-mortem on trades. And then here are a bunch of just short videos on Thinkorswim. If you want your chart to look like mine, here's a short video on how to customize a chart, that kind of thing. Okay, so let's come back, and I wanted to look at JP Morgan. You guys may have already figured that out since JP Morgan was up an example trade when we first came in. So when we look at JP Morgan, like the financials were for a period of time getting kind of hammer smashed, weren't they? And, like along with the rest of the market, we're kind of in, as a group, kind of correction territory. Like in JP Morgan was kind of along for the ride, like, at one point down 16%. But then we've had this diagonal resistance breakout, and it just didn't squeak its way over this line. It gapped up. And then, as James has frequently talked about in his Tuesday webcast, when something gaps up, one resistance level may be the bottom of this candle from the gap, and that does appear to be acting as a support level, right? So let me get rid of that line. So, because it's come down and kind of flirted with this several times. And now today, it's had this pullback today moving up. And this to me looks like a piercing line candle. We had a down day, and then the body of today's candle it's a big candle, and it's moved over halfway through the body of the red candle. So if we look at this and we say, well, if we're kind of sort of bullish, because it's been kind of consolidating here, like, could we maybe sell the 305 or even the 300 and do a short put vertical instead of a long call vertical, which by its nature tends to be more directional and more bullish overall? With a short put vertical, if we can sell the 300 and it's already at 310, as long as it stays above the strike that we're selling, we'll ultimately have a profitable trade, or have the potential to have a profitable trade. So if we came out, say, this 3-week time frame, again, does it trade? If you look at the example trading plan, does it trade more than 1 million shares a day? Check. So if we look at this, check. Is it in that like 20 to 50 day time frame? Check. When we look at, say, this 300 or the 305, are there at least 20 times the number of contracts we're thinking of trading? Check. So that's a check. Is the bid-ask spread tight? Well, this is 35 cents, 25 cents. Check. And if we did the 300 and 295, yeah, check, check. So check, check, check. Do we have something on the charts? That's a check on the charts too. So, so we've got, Houston, we've got the signal to go. Okay. So we are going to clear our check marks and look at, well, let's see, could we do the 300? Our delta is 26. We want a delta of somewhere in that 20 to 40 range. At this delta, and I brought up probability of it being in the money. The probability of it being in the money, we want to do the 25 here. The probability of it being in the money at expiration, about 30%. So that means you've got a 70% chance of it expiring worthless. Okay, so we are going to look at selling a vertical. And we get $1.11. And we're looking at being in this for 25 days. So we want at least a 25% return on our risk. So I'm not a mathematical savant or anything like that. But if I look at $1.11 and we divide that by 389, which is $5 minus the $1.11, that looks like it's going to be, over 25%. So it's a potential return of 28%. Now, would we get more if we did the 305? Well, we can check it out. And the answer will be yes, because we're taking more risk. So we get a better return, but, then the probability of it being successful is less. So it's like, how confident are you, in this trend? Because here's the 305 line. If you're saying, well, I'm cool with the 305, I'd rather make a 145 divided by 355. I think a 40% return sounds sexier. Well, yeah, sure. But you remember the probability. Okay. So we're going to come single order. So how many of these are we going to do? How much are we risking? Well, we're risking $355. Are we cool with risking 700? No. And that's another thing that's in our example trading plan is, what's our max position size? How much are we willing to risk on a trade? So if we look at that and we say, yeah, no, we're not willing to risk. We're not willing to risk 700. So we're only going to do one contract. And for this one, we're going to say, in our example trading plan, would suggest when you've got 80% of your max gain, let's buy it back. So let's buy it back when it's worth about 29 cents. Now, like if we meet again on Friday, and this Friday we're having a special day, so we won't be having trading a smaller account. It's an investor day and we've got special programming for you all day. So next Monday when we meet, we might just say, hey, if we've already got 60% of our max gain and we have a candle that's showing up that's indicating that it may start pulling back. Could we close it out? Absolutely. But are we going to put this in as our target to start? We are. So we're going to put that under our short put vertical and hit send. So somebody said that they were finding this confusing. So if you're not that familiar with this strategy, I'm going to edit this and make this 305. So we sold the 305. So what does it mean when we sell a put? Well, when we sell a put, what it means is we're willing to buy the stock at 305. Well, that would take up our whole account. We only have 31,000 in the account. That would be a $30,500 position, which, you know, breaks our position sizing rules. Besides which, we only have 1,825 in cash. And so, you know, we couldn't do a cash secured put, but if we have a degree of technical confidence that this might stay above 305, we can then come and buy a put at 300, which gives us the right to sell the stock at 300. And so if we're wrong, the worst case is it gets, you know, put to us at 305. So we now own $30,000 worth of stock, 30,500, and then we sell it at 300. And we're down 500 less what we were paid to get in to begin with. Okay, and this is May 22nd. Okay. And so, you know, as long as this stays above, so if it goes up, we are happy campers. If it goes sideways, you know, and if by, you know, the week of the 22nd, it's still sitting around 310, we're happy campers. And, you know, we've even got $10 worth of wiggle room, or sorry, $5, almost $6 worth of wiggle room, because if it stays above 305, we're still happy campers. Now, if it comes below, and especially if it comes below 300, then, you know, especially as we get closer to expiration, we could have our max loss. But if this gap down tomorrow and was below both strikes, we could be assigned at any time. But the probability increases as you approach expiration. Okay. So there's an explanation on that one. I hope that makes it easier to understand. Okay, well, guys, so what have we done today? Well, we've placed 3 new trades. And one of the questions I get asked often is, if there's a survey, is, can you just review what you did? So we did a buy right covered call on Bank of America with the goal of being called out. We did a long call vertical on CrowdStrike, and then we did a short put vertical on JP Morgan. And all of these we did with the view in mind of a base hit of each of these earning enough to meet our weekly goal of earning $100 to $200. You know, and each of these is bullish or modestly bullish. You know, and I call a short put vertical kind of bullish to neutral, because as long as the stock stays above that strike, it doesn't have to go to the moon and back. You know, it will meet our needs. Okay, so guys, here's what I would like to ask of you as we wrap up. If you haven't subscribed to the channel, do that. Hit that button in the bottom right corner. If you could hit the like button if you found this valuable, that would be, it's a way of letting Kevin and I know that you found this helpful. It also helps move things up in the trading algorithms on YouTube, on the algorithms, so that more people can find this content. And last but not least, follow us on social media, Kevin Horner CS, Barb Armstrong CS on X, and then on LinkedIn. You can find us there also. And one last thing, I am teaching 3 extra classes this week. So today, Cameron May is out of the office, and so I'll be teaching his, and we'll be doing buy right covered calls. So I'll be teaching his covered call and short put class. Then on Tuesday, Mike Fairborn is off, and I'll be teaching his swing trading class Connie has a day off on Thursday, so I'll be teaching her a long vertical class. So if you haven't had enough of me today already, you can put those on your calendar. I do post those on X also when I'm filling in for other people. So, when you see that, you can hit the like button and then add it to your calendar. The Thursday class, I will be treating as a companion class to this class, the verticals and diagonals, long verticals and diagonals. So guys, thanks for joining me. Thanks to Kevin for helping in the chat, to the guys behind the scenes for all they do to bring this to life, and to all of you for continuing to show up week after week. I appreciate you. Thanks. Have a great day. Okay. Oh, yep. And just to just a sec, let me bring this up. And just to reiterate on the disclosure front, remember that options carry some risk. We talked about the risk that's involved there, and stops don't guarantee that we will get out at a particular price. So have a great day. Mr. James Boyd is up next. So grab yourself a fresh cup of coffee and stay tuned. Bye for now.